Welcome all. Welcome to Financial Freedom. My name is Samir Bapat, and today we are going to. I'm going to share with you fundamental analysis part 1. I will be covering all these things: debt to equity ratio, EBITDA, ROCE, ROE, PE, sales growth, profit growth, cash flow, debtor days, inventory days, and shareholding pattern. So around 10 points I'll be sharing in next 3 weeks. Like every Wednesday, I'll take up few topics and share with you. So I think by 3 Wednesdays, we should be able to cover all 3 topics. Today is the part 1 of this webinar. You can always revisit this. I'll upload this on YouTube, so you can revise it on while watching on the YouTube before the next webinar. So let's begin. Let's begin with our first part. Let's start with fundamental analysis. Before we go to fundamental analysis, first of all, it is very, very important to understand or to remember why we are learning all these ratios and all these things. The answer to this question is why we are learning. Why we are, of course, one is to earn money, no doubt about it. And second thing is, so this is charting, this is a screener. And as you can see here, 4272 results found. It is showing 4272 number. This is the number of companies listed on Indian Stock Exchange. That means you can buy the share of companies. We have 4,272 approximately companies from which we have to buy the share. Now, we don't have so much money, neither it is worth investing in all the money. Why we are learning this fundamental analysis is we want to boil down out of this 4,200 odd companies, we want to identify around 10-20 good companies where we can invest. That is the objective. Second objective of learning this ratios and all these things is, if someone tells us some company, okay, this company is very good, then we should be able to analyze whether it is really good or not so good. So we can take an informed decision. We can get information from someone, okay, this company is very good. But we should be able to analyze on our own whether it is worth investing or I'm just investing because someone told me it is a good company. So we have to learn both aspects. So first is to filter down. Second is to verify, cross-verify. If someone tells us this is a good company or there is some good mutual fund. If you come across someone says, okay, this mutual fund is fantastic and this is going to go do a great thing in future. You can go in the list of the companies where that mutual fund has invested. You can see whether you are in line with those investments or not, and then invest in that mutual fund. So you need not invest in a mutual fund blindly just because the mutual fund advisor said that this is a great mutual fund. So this is 3 things which are very important for us, and we all should learn how to analyze the company. Whether we invest basis of any one of these 3 modes, it is okay, but we should learn. So that is the objective. Then, once we know, second thing is, this is very, very important. You have to always remember that there are a lot of ratios. I'm also going to talk about around 3 to 4, I think 4 or 5 ratios like ROCE, ROE, PE ratio, EBITDA, and all that things. Always remember, these ratios standalone has got no meaning at all. These ratios were created to compare between the 2 companies, 3 companies. That is point number 1. Second thing is, I'll give you a very good example. Like someone will say, okay, this is a low PE stock. This is a low PE stock. Right time to invest in low PE stocks. These are good low PE stocks. How many of you have heard this statement? Have you heard this statement? If you have heard, type yes. Multiple times. Okay, great. Okay, so these are like, you will hear this is a like low PE stock and falana stock like that. But this is a trap. This is a trap to make you invest. May or may not be a trap, but mostly it is a trap. It is to make you invest in that company. Low PE, there is nothing like low PE or high PE. It's all relative to the company. IT companies will have their own PE ratios. FMCG companies will have their own acceptable range of PE ratios. Countries will have their own acceptable level of PE ratios. IT company of India PE ratios may be different acceptable than the IT company's PE ratio in US or UK. So don't fall for the trap ki low PE. ठीक है, अच्छी बात है low PE, but is that low PE relative? So you have to always remember, you have to verify low PE means what? Is that company overall that sector is having that much PE, or this is special out of those PEs? And if it is less, why it is less? Just to emphasize on this point, like why it is so relative is, why these ratios are to be compared relatively is, in US, in United States of America, there are lots of people who have gone from India and Asian countries, China and all like that. So my cousin was telling me there that in his son's class, if someone scores less than 70%, then he is called Asian fail, because there is so much competition within the Asians, Indians, Chinese, Koreans, that they study really hard. Their parents are pushing, and those kids get at least 70% and above there. So if they are scoring less than 70%, they are called Asian fail, because it is a relative comparison that, okay, Asians are coming, they are studying here, they will at least score this much. If someone says, no, someone has scored 71% there, or even in India, like we have so much competition and our kids are bringing good scores. Someone says, okay, he got 71%, we'll know, okay, theek hai yaar, aajkal everyone gets 70% and above, almost. So it's all relative term. Why I'm emphasizing on relative term is, don't get caught on these numbers. These numbers are relative. This is only the science part to boil down, to bring down to some decent numbers where you have a decent company. Further, you have to take the art side of it. You have to analyze the business and then only invest. So there are two parts to long-term investing. One is the ratios and all, you understand and you judge, okay, yes, this set of companies are having a good performance in the past. How they will perform in future, you have to come to that judgment and then invest. So it's a long-term investment is a very, very interesting process, and you have to take through that interesting process. It is not a process of 5 minutes, 15 minutes. As a process, you need to invest time, more amount of time. Can I have yes from all of you? If my point is very clear, we have to take all the ratios relative to other companies, relative to peer companies, relative to the same sector companies, relative to country. Don't take any number as standalone. Plus, once we boil down based on this number, that is not the end. You have to do further analysis to see what is the future of the company. So you have to know the numbers and then understand the future of the company, then only invest. Or someone tells you this is a great company, invest, see numbers, see the future, then invest. Someone says mutual fund is great, see which companies they have invested, see their numbers, see their futures, then invest. So that is how we have to go. So let's start immediately. Now here we are going to understand the step number 1 is equity, debt and debt to equity ratio, and what is the interpretation of this debt to equity ratio. People say low debt to equity ratio is good. So if the ratio is good, it is better. Okay, but why? So we'll understand first, we'll understand what is debt to equity ratio. Then we will understand why low debt to equity ratio is a good sign. It is desired. So let me take you to the example here. Okay. Can you see the sheet here? Is it visible, clearly visible? Yes? Okay, great. Thank you. Now, everyone knows, like majority, maybe if you're a student, you have not purchased apartment or something like that, home. But more or less, if you have gone through the process of buying apartment, or you are looking for apartment and you have done some analysis, type A. If you have purchased apartment or you are in process of searching for apartment, or you know how apartment is purchased, type A. Okay. Okay, great. So many of you know. Great. Now, let's say if I, for example, if I have to buy a apartment worth 1 crore, or there is an apartment available for 1 crore, I have to buy that apartment, and I have, let's say 20 lakh in my pocket. So 20, 100, 1, 2, 3. Okay, 20 lakh rupees in my pocket. The property value is 1 crore. So what will I do now if I have to buy that? Loan, correct? I'll have to take a loan. So I'll take a loan of, correct, 80 lakh rupees loan. So the total is this plus this. So 1 crore property I am able to take. What I have done is I have 20 lakh rupees in my pocket. I took 80 lakh rupees loan. So I was able to give 1 crore for the property and take the property in my name. Let's say instead of owner share, I'll write here Samir's share. That is me, my name. Now, who is the owner of this apartment? Let's say apartment I'm taking. Apartment. Who is the owner of this apartment? Bank. Okay. Okay, bank combined. Okay, bank. I thought I was the owner of this home. See, till the loan is not repaid, but ownership is shared. I think it is, the documents are with them. They can sell it off. They have right power of attorney to sell away if I don't pay the loan. Correct? Owner is bank, position with Samir. Okay. Okay. I thought, okay, that is my understanding, that I am the owner of the house. I am the owner of the house. My documents are with bank. So it's a bank's hypothecation. They have a right to sell it off to recover their loan. But I am the owner. correct? It is my home, hypothecated to bank, they have right to sell it away to recover the money. But they cannot come and start staying here. Like bank manager, if he thinks, okay, I'm going to stay in Samir Bapat's apartment, they cannot come and stay in my apartment, correct? Do you agree that, do you think bank manager can come and stay in my apartment? Okay, since you have taken almost 80 lakh loan, okay, we are sending our few people, we don't have accommodation, please accommodate him in your home, right? Correct. So I am the owner. It is hypothecated to bank because I took loan from them. So, but the owner is me. Now, so having established that it is, I am the owner of this home, I have taken a loan and I have told I'll repay it. So the owner's share, the amount for buying this apartment, the total amount of money. Now here is where the technical terms comes in. The amount of money which a owner of a company brings in is called equity. And to start the company, he needs some more money. He brings in some 20 lakh rupees and then he says, okay, nahi, but if I have to start this company, I need some more money. So he takes loan from the bank or he borrows money from someone. That is called debt. Everyone clear on what is equity and what is debt in a company? For any company, whatever money the owners bring in, whatever money the owners bring in is equity, and whatever the loan they take, because loan you have fixed interest, you have to pay back the interest and the principal, you keep on giving back to them, but you run the company. The person who is giving you the debt does not run the company. They will only take the interest and all, and they will have the papers with them that, okay, if you are not able to run company, they might sell it off and take their money, but they are not interested in your day-to-day operations of the company as long as you are repaying the loan. So now what will be the debt to equity ratio? Debt is 80 lakh rupees divided by whatever the money owners brought in for starting the company is called equity. Debt to equity ratio in this case will be 4. 80:20. Everyone okay? Everyone good? Yes, no? Now, so why debt to equity more is good or less is good? If you are going to see a debt to equity ratio, if you are analyzing a company, if you have to buy a company share, then debt to equity ratio should be more or should be less? Less is preferable, correct? Less is preferable. Plus, if it is less, that means tomorrow, let's say if I have an apartment in my name, I have paid off, for example, I have paid off 80 lakh rupees and my loan is 20 lakh rupees. My debt to equity ratio is 0.25. One is lesser is okay. Again, it is relative. Huh? Don't take in a debt to equity ratio, it should be 0, then it is fantastic. No, whatever is the industry standard, our company should have a lesser debt to equity ratio. If the debt to equity ratio is 0.5 for that industry, then our company should have lesser debt to equity ratio. That's it. We have to see. Yes, let it not be too much exaggerated, but this thing. One is lesser is good. Second is if debt to equity ratio is less, that means if I'm going and buying one more apartment, bank will ask in my documents, right? Share us how much assets you are having, liquid cash you are having, how much income you are having, how much apartments you are having. And then when they say analyze our CIBIL score and all, they will see, okay, this fellow is having apartment. He purchased for 1 crore rupees. He has repaid the loan, 80 lakh rupees, only 20 lakh is pending. Debt to ratio, equity ratio is 0.25. Do you think it will be easier for them okay? Now, if he wants to take a loan, I want to take a loan. So I will just change this to owner's share, not Samir's share. Owner's share and this thing. So Mr. A has taken a loan. He has repaid 80 lakh rupees. He has a bank loan of 20 lakh rupees for the total capital invested. His debt to equity ratio is 0.25. Mr. B is invested 20 lakh rupees, taken a debt of 80 lakh rupees for the same property of 8 crore. His debt to equity ratio is 4. For expansion, for let's say if I have to buy one more apartment, Mr. A has to buy one more apartment and B also has to buy one more apartment. If both have same income, if both A and B have same income, whom do you think it will be easy to get more loan? A, correct? So debt to equity ratio, why it should be less is for two reasons. Not only for the reason of that, okay, there is a debt to equity ratio is less is good. Yes, definitely it is preferable. And uh, it is preferable among industry. And second is for expansion, lower debt to equity ratio helps because if the company wants to go and do some more expansion, they will be getting the loans easily from the banks or from the lenders. It will be easy to get the loan for expansion and so on. So expansion, faster expansion possible, faster okay, faster expansion is possible. So debt to equity ratio clear. So one by one, let me take yes from all of you. What is equity is clear. Okay. Second is what is debt for a company. Now I'm talking with reference to company. It is same for a company. Equity is what the owners bring in for the company. Debt is what they take the loan for the company. And what is debt to equity ratio? It is clear, correct? We will go and see the company also. Now, let's say we'll continue with the apartment example and then I'll take the company's example later. Now, let's say 1 crore property, how much rental income will get? Approximately, let's say in Bangalore, any idea 1 crore property? Nay, in terms of money, I want 3%, 40K per month. Okay, so let's take 25K looks reasonable. So if it is 25K per month, then 12 to the 24 and 12 5 is 60. That is 3 lakh 10, 1, 2, 3. 3 lakh 10,000. Correct, no? 3 lakh 10,000. Correct. Yearly rent, how much will get? This is correct, na? Let's make it 30,000. 3,60,000, we will get rent. Let's say we are doing some expenses on maintenance of that home. We will do some expenses, not much expenses required for that home. Let's say we did some XYZ painting, maintenance, something we paid. We paid 30,000 for that maintenance expenses. So let's say 30, 1, 2, 3, 30,000 we paid. So finally, if I say what was my income, total income from the rent minus the expenses. So finally, I have in my hand from that rent 3,30,000 rupees. Is that okay? Everyone okay with that? Hello. Some expenses happened, some maintenance charges, some society charges, some municipality charges, something like that for that has happened. I earned 3,60,000 rupees as a yearly rent, and then I paid 30,000 rupees for expenses and all. So I am left in hand with 3,30,000 rupees. Okay. In company's parlance, if you see, let me take one example of company. Just to keep the two things connected, I'm taking you to this website. Okay. Now, I'm just taking one example of MTAR. This is MTAR company, MTAR Technologies. I'm just taking the example for example's sake. This is the annual result. And if you see at the end here, March 2023 result is there. So MTAR must have started a company. The owners must have brought in some money. They brought in some money from their pocket. They took loan. So it will reflect here in debt to equity ratio 0.23. That means the amount of loan they took and the amount of money they got in from their pocket divided by debt to equity ratio, it is 0.23. These are the companies which are in the similar line as per the screener. So you can see different debt to equity ratios. It seems that this is on the higher side for MTAR. It is on higher side. That is still okay. It is neither negative, neither positive, but it should not be too much. But relatively, yes, it is on the higher side. Okay, done. Then they did the business in the year 2023. This was their total revenue. Sales, total sales was 573 crore rupees. Okay. 573 crore rupees. They gave salaries to people, material cost, all the cost, whatever it was the expenses. They gave the expenses of 419 crore. And finally, they have profit. Whatever is left, expenses, total sales minus expenses, they are left with 154 crore in their hand. Parallels to apartment, just I'm making a simple parallels to apartment. If you have apartment, we have 3,60,000, we got the rent, some expenses we did. So in our hand, we are left with 3,30,000. Okay, everyone with me? No one is getting confused, right? Between the two examples. I'm just trying to correlate between the two so that it is very clear. Everyone with me? Can I have yes from all of you if you are with me? Yes. Okay. Now, okay. Now what is ROCE? ROCE comes in. Okay. ROCE, return on capital employed. How much capital did we employ in buying this apartment? We employed 1 crore in buying this apartment where we got 3,60,000 rent we expended. Then earnings before interest, tax and amortization. EBITDA is, sorry, it's called earning before. Whatever is the earning before interest, tax and amortization. Okay, so earnings before Interest, tax and amortization is 3,30,000 rupees, what we have available. Now ROCE is, this is what we are having in hand. Then what was the capital invested is 1 crore rupees. So return on capital invested is 3,30,000 divided by, we got this 3,30,000 by investing 1 crore in that property. So percentage wise, return on 1 crore of capital invested, capital, the entire capital of 1 crore invested is 3.3% for this year. So this is called ROCE for the apartment purchased by A. The return on capital invested is 3.3. ROCE is 3.3. For B also, let's take it same. So for A also ROCE is same. For B also ROCE is same. For MTI technology, they will have the same calculation. Whatever is the money they invested, they will give at the end. If you scroll down here, you can open a free account in screener.in. This ROCE for this year, if you can see last where I'm moving my mouse, this ROCE they have shown as 23% ROCE for MTAR. That means whatever money, equity plus debt, whatever is the earnings after the expenses, sales minus expenses, earnings before interest, tax and amortization divided by the total capital, whatever is the return is called ROCE. Now ROCE again we want higher the better or lower the better? Hello? ROCE higher the better or lower the better? Higher, correct? Higher the better. Okay, great. Now, again, coming back to the example of apartment, and then we'll correlate with the company. It is almost same, similar. I would say not same, but similar. Now, if I have taken a 80 lakh rupees loan, the approximate interest what I will be paying on that loan is how much? Can someone tell me what is the loan? Because I'm not having a loan, so approximately for 80 lakh rupees yearly loan, how much you have to repay? EMI, how much it will come? I think it is 1 lakh per month approximately. 9.9 EMI kitna hoga? Should I take 1 lakh per month for 80 lakh rupees, or how much? I think it is 80,000 rupees. Okay, I'll take 80,000 rupees per month as a EMI. 80,000 into is equal to 12 into 80, 1, 2, 3. Okay, so what I am doing is 9,60,000 I am paying to bank for 80 lakh rupees loan I am paying. Okay, so most likely I am not paying any tax because anyway I'm getting tax exemption, so I'm not paying any tax on the earning. So on this earning 3,30,000 I am paying already 9,60,000 as my EMI. So most likely I'll get the rebate and everything, and I'm not paying any tax on whatever I'm earning on the rent if it is my first apartment and all. Let's say there is no tax. So Oh, sorry. Owner share is that. So sorry. My bad. Thanks for pointing out, Purvi. So EMI is 20,000 for 20 lakh. It will be 20,000. Okay. Uh, 20,000, 20 lakhs का कितना होगा EMI? Let's take 20,000. So it's equal to 12 into 20, 1, 2, 3. Okay. So I am paying 2,40,000 here, and B is paying. Okay, so EMI would be less, correct? So 2,40,000 I am paying. So I'm okay. So let me insert some column here. EMI paid is 2,40,000. Profit before tax is 3,30,000 minus this. So I'm having profit of how much? 90,000. Correct. Now it's okay, Purvi. Others? Yes, no? Correct. Okay. Let's say I'm coming into 20% tax bracket. If let's say I'm paying 20% tax bracket or 33% tax bracket. So let's calculate 33% tax bracket. So let's calculate this into 0.33. So I'm paying tax is 29700. Then profit after tax is this minus this. So I'll get 60,300 in my hand. Okay, everyone clear? Can I have yes from all of you if you are clear? So we earned before for 1 crore property, 80 lakh was my owner's share, 20 lakh rupees loan taken, 1 crore property, debt to equity ratio, yearly rent is 3,60,000, 30,000 was expenses, 3,30,000 was earning before interest, tax and amortization. Return on 1 crore capital employed was 3,30,000 divided by 1 crore. So 3.3%. Then interest was paid. See, EBITDA is earnings before interest and tax. So now I'll calculate how much interest I paid. Let's say I paid 2,40,000 interest, 2,40,000 interest minus the earnings, EBITDA. 90,000 left, 90,000 में से tax pay किया 33%, 29700. So profit after tax is 60,300. Can I have yes from all of you if you are with me? Clear? Okay. Now, ROE is return on equity. ROE is return on equity. What is my equity? My equity is the owner's share, what the owner got, right? No, Kulpreet, amortization is something different, but we are just taking interest and principal here for the understanding sake. Okay, I'm not from finance background. I'm just explaining you on a very higher term. But I'm not explaining you wrongly. It is perfectly right. Okay. Now, what is the equity for A, apartment A? How much is the equity? 80 lakh rupees. On 80 lakh rupees, finally, I got 60,300 rupees as the profit. That is a return on equity. I invested in the beginning of the year, or for taking this apartment, I invested 80 lakh rupees from my pocket. So how much return I got on my pocket? So that is 60,000, which is 60,000 rupees divided by 80 lakh rupees in percentage terms. I was able to earn 0.75%. 5%. So ROE is 0.75%. So there are two calculations, ROCE and ROE. Correct? Everyone is able to make the difference. What is the difference between ROCE and ROE? Yes, no? Same thing is if someone is having, let's say, owner share is 20 lakh and debt is 80 lakh rupees, then the EMI is around 12 into 8123, 80,000 rupees. So his MI itself is 9,60,000 rupees. Profit before tax will be 0 because he has earned 3.3, and in fact he will have negative earning. Correct? He is earning 3,30,000 and he's paying 9,60,000 as a interest and principal to the bank. So there is no tax on him for that. So it's negative. So tax paid is 0. How much is profit after tax? How much is profit after tax for B? Full 9 minus, correct? Minus, it will be having minus 6,30,000, 1, 2, 3, 30,000, right? 6,30,000. So his ROE will be this divided by owner share equity is minus percentage. Okay. Okay, so whatever is the profit after tax, he is having a negative profit after tax divided by the equity. So he is having a negative return on equity. So whatever at the end of the year, the owner, whatever money he put on the company, whatever investment was there on the company, he got returns as negative. ROE, we will get here return on equity. ROE. There is ROE here. ROE is mentioned here. Last year for MTAR, return on equity is 18%. Okay. So we have learned 3 things today. First is ROCE, return on capital invested, which is here. ROCE is 23%. Then we have understood ROE, which is 18% here for MTAR, and debt to equity ratio is here. So again, debt to equity ratio, we want more or less. We want the ratio to be higher or lower? Less. We want ROCE to be more or less? ROE to be more or less? Okay. So now if we have if we want to shortlist out of 4,272 companies, if you want to shortlist out of 4,272 companies, then there's a fantastic tool here, Screener. You can go to Screener, you can create a new screen, you can create a query that debt to equity. You can type debt to equity. You can later on see the video. I'll upload it on YouTube. You can watch how I'm typing. You can copy exactly from there. Less than 1. At least I want 1 less than 1. And ROCE. We want to, if we are into stock market, it is my firm belief, my personal belief that we should be able to at least earn more than 15%. And if I'm earning more than 15, if I want to earn more than 15% on my capital whatever capital I am putting into stock market, if I want to earn more than 15%, then I should be investing in company which has ROCE greater than at least 10% or 15%. For today, I'll take 10%. And ROE, return on equity, to be greater than 15%. And you can run the query and see with this 3 simple steps, that debt to equity ratio less than 1, ROCE greater than 10%, ROE greater than 5%. If we made this filter, we have a filter of 890 companies. So automatically, by using these 3 filters in step 1, our almost how many 60%, 70% of the companies are removed. So we are not worried about those companies, because in our view they may be good, but right now for our requirement we have boiled it down to 890. Everyone clear? Can I have yes if you are clear? So far so good. Okay, so let me take you through MTAR, and just in the terms of balance sheet from this MTAR, let me share with you. Again, for any company, equity is the amount which the owner invests in that company. That is equity. They take loan from the banks, they take from the lenders, they take, that is a debt. Owner of the company, he is the person who brings in the money. The person who gives a loan, they have they don't have ownership on that company. They have given the loan, they can recover the loan, but they cannot meddle into day-to-day operations, what product, what, how it will be sold, sales and all. No, everything is decided by the owner. He has to repay the loan. So the people who give the loan are only limited to the loan given. So that brings in the total capital. Once total capital comes, the businessman does the business, the company does the business, they will have a sales, whatever sales. It may be someone might be selling the software, hardware, something. Finally, it has to boil down in the number, the amount of rupees, how much business was done. So it is 573 crore rupees business was done in 2023. They had their own expenses. What is the expenses here? Expenses is material cost, manufacturing cost, employee cost, other cost, whatever cost it may be. All this cost was incorporated. So when the sales minus expenses, whatever is the profit come from this profit itself. So this is earning, whatever they have earned before interest, tax and amortization. If you see, the interest is written here, depreciation is written here, profit after taxes here. So all these 3 things are written after that. So 154 has come. 154 will be divided by the total debt plus equity. So total capital put in the business, 154 divided by the total capital invested in the business, which includes the owner's money and the loan from the bank. This will give ROCE, return on capital employed, complete capital employed. Then we will pay interest to the bank कि भाई ये लो अपना पैसा, interest लो, principal लो, depreciation निकालेंगे. Then we'll do profit after tax, profit before tax, calculate the tax, net profit. We will see how is the net profit. This is the profit of the money invested by the owner. So 104 divided by the money brought in by the owner, that is ROE. Again, this we want to be on the higher side. So we want both ROCE and ROE on the higher side. With that, we did the filter. Here, Screener has a beautiful filter. We said debt to equity is less than 1. Even you can reduce it to, or let it be 1, no problem. Return on capital employed is greater than 10. If you do 15, both 15 greater than 15, return on equity greater than 15. Run this query, you have 871 results out of 4:7:2. So almost like 8 4s are 32. So we have removed almost 80% of the companies out of 4:7:2 companies have been removed. Even when you have to compare, anyone says, okay, this is a good company, at least do a quick check of these three things. At least this you should be having a good ratios. Fine. So how many of you have learned something new today? Something interesting, something which you can use to verify a company. Now you can confidently use, you know exactly what is the ratio of the company and you can use it. If someone tells this is a good company, at least you can do some basic checks, right? You can do some quick checks. Thank you, Anirudh. Okay, so with that, we come to the end of part 1. We have already covered, let's see how much we have covered today. Okay, out of this, we have covered debt to equity, EBITDA, ROCE, ROE. We have covered these 4 points. I'll cover PE also, or okay, we can cover it again. It will take little time. So we have covered this 4 points today out of 10. Remaining 6 we will cover in coming 2 sessions. So any questions? Anyone is having any questions? Write your name. I'll come to you. You can unmute. You can ask me the question related to whatever we have discussed today. Yeah, Anirudh.
So whatever we have learned today, no, none of these ratios are function of the price, right? Of the script price.
Script price will start coming from PE, price to earning ratio.
Okay.
So what happens is whatever is the profit, final profit, no. So final profit divided by total number of shares is earning per share. So price per share divided by earning per share, you have PE ratio.
For today's one, there is nothing.
Today till now the price action
is fixed ratio, sir.
It has not come.
Okay, thank you.
Yeah, thank you.
Thank you.
Yeah.
Hi, Samir. I have a question. This is Lancho.
Yeah.
So basically, these 2 ratios, one ROCE and ROE. So in ROCE, the numerator is EBITDA, whereas in ROE, the numerator is your net profit, right?
Profit after tax, yes.
Right. So why we look at the ROCE as EBITDA? Why don't we look at a particular ratio as net profit by capital employed, for example?
EBITDA is
in one ratio in numerator there is a EBITDA, in another ratio there is in numerator there is a net profit. So why these 2 are different? Means
the one EBITDA is on the total capital. जो loan लिया है and one we have taken the loan plus whatever is invested by the owner. Like if I'm buying apartment, 20 lakh is brought in by me, 80 lakh is from the government. So EBITDA is seen on the entire capital, which includes the loan taken and the money invested by the owner. That's the EBITDA.
Okay.
After EBITDA, I pay back my interest to the my bank. I'll pay back the interest to the bank and debt to the bank. So whatever is left, then I'll pay the tax.
Okay, I got it.
No, I'm coming to the point. I'm coming to the point. Wait.
Yeah.
Now, what happens is whatever is profit after tax, it is my money, owner's money.
It's owner's money. Yeah.
No. Wait. That is owner's money. In that, if I want to declare the entire money as dividend, I'll say, okay, I'm declaring everything as a dividend. I'll pay all the money, whatever I have earned in the this year, whatever was the profit after tax this year, I will distribute it as a bonus to all the owners. I can do that. Bank cannot have a say in that. You cannot distribute it as a dividend. I will say, okay, I'll take everyone to world tour with that money. That money belongs to owners. Owners can decide whether that money has to be reinvested into business as our own money. So it is like owners' money. They can decide to reinvest in business. They can declare it as a dividend. They can take all the owners for world tour, whatever they want to do. Bank has no say in that. Correct. So that is the purely owner's own money. They can do anything with that money. So there are two ratios. One is one ratio along with the money of bank. Second ratio is the money what the owners got. So that's why there is a difference. And there is a difference because in the first EBITDA, you have to pay to bank. After profit, bank cannot question you what you do with that money. Right? So that's why these two ratios are taken. You have to understand also that why second profit after tax is very, very important, because dividends are declared after profit after tax in that. So EBITDA, you cannot declare dividend. Okay, I had such a great EBITDA, I'll declare the dividend, but profit after tax, I can declare dividend in that. I can give it to owner, I can reinvest as a owner's money back into business. So my owner's share increases and debt decreases. So my debt to equity ratio will keep reducing. That is the importance of 2-point check. This is only for us as an investor. It is only 2-point check. That's why. EBITDA is before obligation. Correct. Absolutely right. Okay. Any other question for today before we call it a day? Then remaining 4 points we'll take in the next session, and last 2 points in the last session. Okay. So great. No more questions. Thank you so much for joining. See you next Wednesday, 9 o'clock with the remaining. We'll have 4 points next weekend and 4 points. So I would request everyone to watch the YouTube video, log in, create a login to Screener, and you can see these numbers and filter it out as shown in the webinar. Thank you. Thank you so much. See you on next Wednesday.